Hello guys, welcome to my online prep. In this video, we'll be doing the 15th chapter, the third chapter from our module C, Ratio Analysis. Let's start. The agenda for this video would include, in general, what ratio is, then classification of accounting ratios, use and limitations of accounting ratios, and then we'll move further to the liquidity ratios, solvency ratios, turnover ratios, and profitability ratios. We'll take some of the examples for these also. Okay? Ratio analysis is a quantitative method of getting an insight into the company's performance. It could be liquidity, solvency, operational efficiency, turnover related insights, profitability, or any other measure for comparing information contained in the financial statements. Basically, by looking at the ratios, investor can compare a company's performance to its peers or industry standards and decide in which company to invest. Moreover, these data can be used to compare the company's performance to assess whether the company is improving or deteriorating with respect to other companies or industry average, right? Also, this can help to look at the various trends from companies' financials. So that's the basic idea behind this analysis. Other than this, ratios in general is calculated by dividing a numerator by denominator. A ratio is basically how much times the numerator is of the denominator. If the ratio is x by y, the ratio can be interpreted as how much times x is of y, right? Remember this vividly because this will help in interpreting different ratios at different point of times. But the basic idea, the significance, the core understanding will depend on this very explanation. How much times the numerator is of the denominator, right? Okay. Before we discuss the ratios, let's understand some of the usage of the accounting ratios. Number one, simplification. Ratios simplify the decisions which we take on the basis of financial statement. Why? Because at the face value, if you look at a particular financial statement, there are only figures. It is very difficult to take a decision there and then. Ratios basically give a better sense of judgment because there are comparisons involved when we deal with ratios, right? Number two, when we are talking about comparisons, there are two different types of comparisons. First is inter-firm comparison. Very easy. Two different organizations can be compared with the help of ratios, and then we can take a decision as to which organization is performing better. Similarly, we have intra-firm comparisons. Comparisons between two branches or divisions of an organization, that is also possible with the help of ratios. And last one is planning. Since it's possible to take a decision on the basis of ratios, it definitely helps in planning and budgeting. If the data changes over a number of years, it's easy to predict changes with the help of ratios to understand trends. Understood? Okay. Now, on the other hand, ratios have certain limitations too. Let's take it one by one. First one is comparisons. Yes, comparison, which is actually an advantage, can be a disadvantage too sometimes. How? See, we are comparing the financial statements with the help of ratios. We take the help of past data and then take a decision and predict future. Sometimes it happens as if the future doesn't correspond to what we actually predicted. Basically, it's the uncertainty involved with the comparisons of data, which results in a limitation of these ratios. Similarly, there are limitations of financial statements, which will eventually become a limitation of ratios. How? See, ratios are prepared on the basis of financial statements, which doesn't consider the non-financial factors at all, like changes in the management or top officials. We all know changes in the human resources at such a high position will always have an adverse impact on the organization. Since these are not considered by financial statements, these are not considered by ratios. Also, different companies may follow different policies, accounting policies, to record their transactions. This may lead to comparisons becoming redundant at all, because then it won't make sense, right? So all these factors do play a key role while deciding the limitations of ratios. Next is window dressing. Let's understand this with the help of an example. Suppose current ratio of a company is 2:1. Current assets 2 lakhs and current liabilities 1 lakh. Now the company which we are talking about buys 50,000 worth of inventory on credit. What will happen? This would make the current assets to increase to worth 2.5 lakhs because of stock, and also increase in current liabilities to 1.5 lakhs due to increase in creditors, right? Eventually, this will reduce the current assets ratio. How? This will become 2.5 lakhs current assets divided by 1.5 lakhs current liabilities, and the ratio would be 1.67. So it has reduced from 2 to 1.67. Here, the company may postpone the purchase of stock to a later date so that the ratio remains intact on the last day of the financial year, on the balance sheet date, right? So this is a kind of window dressing. Similarly, if the company wants to improve the ratio, if it wants to increase from the current ratio, that is 2:1, it may pay off certain liabilities just before the balance sheet date to reduce the denominator, that is current liabilities, right? And this will improve the ratio. Understood? So this is how window dressing is done with the help of ratios. Last but not least, standardization. When we discuss different ratios, we'll discuss the ideal ratios too for that particular category. Basically, what the usual norm is in the industry, that will be an ideal ratio. But there is no standard way to deal with this. Different organizations may look upon these ideal ratios differently, right? So an ideal ratio in itself is not a benchmark for comparisons of data, though they are suggested, right? They are suggested ratios in the industry, but they are not the exact benchmark, right? Understood? Let's move on. The accounting ratios in general can be classified into 4 broad categories. Liquidity ratios, which considers the short-term aspects of the organization. Then we have solvency ratios, which focuses on the long-run aspects of the organization. Then we have turnover related ratios, which considers various aspects of the organization with respect to turnover. And then last but not least, which considers the various factors with respect to profitability of the company, called profitability ratios. Let's take all this in detail one by one. First up, the test of the business's liquidity, its capability to pay its liabilities that come due in the next period or near future up to 1 year, is basically what we are dealing here under liquidity ratios. This is also known as short-term solvency ratio because it gauges a company's ability to pay off its short-term obligations and convert his assets into cash so that it can meet those obligations. These ratios are a rough indicator of whether cash in hand plus cash to be collected from accounts receivables or from selling any inventory would be enough to pay off the liabilities that will arise in the near future. The liabilities, the current liabilities, which will arise, which will demand payment from us in the near future. There are two ratios under this category: current ratio and quick ratio. Let's take this one by one. Current ratio, which is equal to current assets by current liabilities. When we say current assets, it would mean all short-term assets like current investments, inventories, trade receivables like debtors or bills receivable, then cash, bank account, and then any other current assets like prepaid expenses or any advance tax. On the other hand, current liabilities would include short-term borrowings, trade payables like creditors or bills payable, then short-term provisions, etc. But more than mathematics, numerator by denominator, we need to understand the intention behind this. We are computing here how much times the current assets is of the current liabilities. If we had to pay all our current liabilities using the current assets, how much would be still left after the payment? That is what we are calculating. The amount we'll get, that is from the current assets, divided by the amount we owe to others for the short term, that is current liabilities. Basically, how liquid an organization is, its ability to meet its short-term obligations. So, more the current ratio, better off the organization is, and lesser, the worse. Get it? As per industry standards, the ideal current ratio is 2:1. Although this will not hold true for everyone, but the ideal current ratio which you need to remember here is 2:1. So anything more than 2:1 would mean the company is able to pay off its current liabilities. But anything less than that indicates lack of liquidity or shortage of working capital, because working capital is current assets minus current liabilities. This you already know. So if there is low current ratio, it would mean shortage of working capital. Understood? Okay. Similarly, we have quick ratio or liquid ratio, or it is also known as asset test ratio. Very similar to current ratio, the only difference being that in place of current assets, we have quick assets. So quick ratio equals to quick assets or liquid assets divided by current liabilities. Now, what are quick assets? Quick assets are those current assets which can be converted into cash instantaneously in a very short period of time. All current assets are liquid assets, except, you should remember this, except inventories and prepaid expenses. So it would mean to know how quickly an organization can convert its liquid assets, not current assets, liquid assets to pay off its current liabilities. This is a more rigorous test of liquidity than the current ratio because it gives a better picture of the short-term liquidity of the business. An ideal ratio in this case is 1:1. There it was 2:1. Here it is 1:1. So basically, Whatever is converted into cash here should at least be able to pay off our liabilities, pay off our current liabilities. Understood? So these two, current ratio and quick ratio, are the ratios for measuring the liquidity position of an organization. Understood? Let's take an example for this. Suppose we are asked to compute the current and quick ratios from the given information. Let's do it. First, current ratio. For this, we need two things: current assets and current liabilities. Current assets, as we already know by now, in this context, we'll compute current assets by summing up current investments, inventories, trade receivables, prepaid expenses, then short-term loans and advances. Don't confuse this. Short-term loans and advances are advances given. So these are current assets. Short-term borrowings is current liabilities. Okay. Then under current assets, we'll include cash and cash equivalent. And last but not least, advance tax, which is a kind of prepaid expense. Adding all this up, we would get current assets as rupees 1,42,000. Similarly, current liabilities can be computed as summation of short-term borrowings, trade payables, short-term provisions, and then other current liabilities. This would sum up to rupees 61,000. Clear? Now the current ratio can be computed as current assets by current liabilities. This would give us a current ratio of 2.33. Remember, we discussed that the ideal current ratio is 2:1. Here we have got 2.33. Since this is more than the ideal ratio, it is fair to assume that the business is being carried on fairly well by the organization. Understood? Similarly, we'll calculate quick ratio. For this, we need quick assets or liquid assets. As we say, quick assets can be computed taking all the current assets except inventories and prepaid expenses. We have already computed the current assets. To compute the quick assets, we'll deduct the inventories and prepaid expenses from current assets. We have inventories here and we have prepaid expenses. Also, we have advance tax, which is a kind of prepaid expenses that I already told. So this also we'll deduct and we'll get quick assets as rupees 1,12,000. Current liabilities we have already computed. So we can directly calculate the quick ratio as quick assets divided by current liabilities, which will give us a ratio of 1.84. Here also, since the ideal ratio is 1:1, since the ratio computed here is 1.84 in this case, which is more than the ideal ratio, so the company is better off. Understood? Okay. Next up, we have solvency ratio. This is a key metric which is used to measure an enterprise's ability to meet its debt obligation. It indicates whether a company's cash flow is sufficient to meet its short-term as well as the long-term liabilities, both. There are certain ratios under this category which we need to understand. First one is debt equity ratio. We have already discussed a brief format for balance sheet in other chapters. In this ratio, our focus will be on the liabilities side. This ratio expresses the relationship between long-term debts and shareholders' funds. Long-term debts are debts which are borrowed from people other than the owners, that is, outsiders, whereas shareholders' funds is whatever belongs to the owners of the organization. It is a comparison between the owner's funds and outsiders' funds. Debt equity ratio can be simply written as debt divided by equity, or long-term debts divided by shareholders' funds, or we can say net worth, capital. Long-term debts would comprise of long-term debts as well as long-term provisions. On the other hand, shareholders' funds would comprise of share capital, be it equity or preference share capital, then reserves and surplus, which includes capital reserves, security premium, general reserve, retained earnings, or any other reserves for that matter, which is shown in the balance sheet on the liabilities side. Now, what's the significance of this? Why we are calculating this? This ratio is calculated to assess the ability of the firm or an organization to meet its long-term liabilities. Generally, debt equity ratio of 2:1 is considered safe. Anything more than that is considered risky, because it means that what we owe to the outsiders is more than twice of what we owe to our owners, what belongs to our owners, and more than 2:1 is a signal of danger. But lower the ratio, the better it is for the long-term lenders, because it's secure in that case. The owner would be able to pay off the outsiders. Right? Okay. Another such long-term ratio for solvency check is fixed asset ratio. In this case, we'll focus on the assets as well as the liabilities side of the balance sheet, because this ratio is computed as fixed assets divided by long-term funds, not long-term debts, long-term funds, which means both owners' funds as well as the outsiders' funds. Remember here that this ratio should not be less than 1. Wondering why? Because think, in that case, it would mean that fixed assets is less than the long-term funds, because fixed assets is a numerator here and long-term funds is a denominator here, and we are considering a ratio less than 1. So fixed assets is less than long-term funds, and that would imply that long-term funds have been used to finance working capital. How you say? Because all the long-term funds have not been utilized for funding fixed assets, but for current assets as well, and this is a part of the working capital. Get it? Understood? Okay. Let's take an example for this too. Suppose certain information is given and we are required to compute debt equity ratio and fixed asset ratio. Here also we'll compute the numerator and denominator separately and then proceed on to compute the ratios. For debt equity ratio, we need long-term debts and shareholders' funds. Long-term debts is very easy. There is only one liability which will become part of the long-term debts. That is 12% long-term loans. And then as part of the shareholders' funds, we'll take the equity share capital, preference share capital, then general reserves, and last, balances of profit and loss. This will give us a shareholder fund of rupees 5 lakh. So debt equity ratio would be 1,80,000 divided by 5 lakh, giving us a ratio of 0.36. This means that debt, long-term debts, is very less as compared to the owner's capital, right? Similarly, we'll compute the fixed asset ratio. For that, we need the fixed asset, which is very easy to locate in the balance sheet, the right hand side, the asset side. We also need the long-term funds, Don't confuse this with the long-term debts. Long-term funds comprises both long-term debts as well as the shareholders' funds. We are talking about long-term funds here, not long-term debts. Debts is only a part of funds. Basically, the long-term sources of funds. So we'll include both long-term debts as well as shareholders' funds. This would sum up to 6,80,000. So fixed asset ratio would be 4,50,000 by 6,80,000, 0.66. And as we discussed, since this is less than 1, that means the long-term sources of funds have been invested in other than fixed assets. Could be current assets. So it is fair to say that the long-term sources of funds are utilized to fund the working capital. Easy, right? Okay. Turnover ratios, also known as activity ratios. These indicate the rapidity with which the resources available to the concern are being used to produce revenue from operations, sales basically, or turnover. In other words, these ratios measure the efficiency and rapidity of the resources of the company. Resources like inventory, fixed assets, working capital, trade receivables, etc. A hack to remember these ratios are that they are calculated taking revenue from operations or sales turnover into consideration as the numerator. Always. Some of them we are going to discuss here. First one we have here is stock turnover ratio, which is calculated as turnover divided by stock. We are taking stock as part of the denominator. But what stock, you may ask? Opening stock or closing stock? Well, we have to consider the stock for the whole year. So here we'll calculate it as the average stock, taking opening and closing stock and then dividing it by 2. So average stock would be opening plus closing by 2. And in the numerator, we'll take cost of turnover, more popularly known as the cost of goods sold. Why? Because see, remember I have mentioned this multiple times in a lot of earlier videos that stock is considered at cost. So no explanation needed there. So to maintain the harmony between the numerator and the denominator, which stands a very basic rule to compute ratios in general, we have to take a numerator of similar nature. Since we have to comprehend turnover in the numerator, it is logical to take cost of such sales as part of the numerator, because we have taken cost of stock in the denominator. So in the numerator also we'll take the cost of turnover. Get it? Right? Okay. Similarly, the other turnover ratio is debtors turnover ratio. Exactly like stock turnover, here we have turnover divided by debtors, or more precisely, net credit sales divided by average trade receivables. There we took average stock as denominator, but here we have average debtors or trade receivables. And since we are taking debtors or trade receivables as denominator, basically the ones to whom we sell goods on credit, to maintain the harmony between these two, that is numerator and denominator, we have to take credit sales as numerator and not total sales. Here you should also remember that why am I mentioning trade receivables along with debtors? Because if bills receivable is given, then you have to consider both and that would mean we are considering trade receivables. Understood? In terms of significance, it indicates the efficiency of the staff entrusted with the collection of book debts. Higher the better, lower the worse. This was easy to guess. Higher this ratio, better off the company is. Lower the ratio, it is in a worse position. Higher ratio would mean that the debts are being collected more promptly. Also, with this reference, there is one more ratio which we need to discuss, and that's debt collection period, which indicates the extent to which the debts have been collected on time. This ratio is very helpful to the lenders because it explains to them whether their borrowers are collecting money within time. Debt collection period can be computed as days or months in a year divided by debtors turnover ratio. This can be otherwise written as average accounts receivable multiplied by days or months in a row divided by net credit sales. Right? Understood? Okay. Let's take an example. Suppose trading account is given and we are asked to compute the stock turnover and fixed asset turnover ratio. Same concept. Let's calculate the numerator first, that is cost of goods sold. Remember, we discussed this during the other chapters. How we'll compute this? We'll take the opening stock first, then add purchases, then add other direct expenses, that is wages and freight in this case, and then deduct the closing stock to compute COGS. This will come up to 15,95,000. Similarly, we have to compute the denominator, that is average stock. This we'll compute by taking the opening and closing stock, adding it up and then dividing it by 2. We'll get an average stock of rupees 7 lakh. Then stock turnover ratio can be computed as COGS by average stock. This will give us a ratio of 2.28. This means an average stock of 1 rupee actually contributes to 2.28 rupees of sales. Cost of sales to be precise. Understood? Similarly, we'll compute the debtors turnover ratio. The numerator, that is sales, can be computed directly by taking sales from the trading account. This is because there is nothing given regarding credit sales. So it's fair to assume that all the sales were done on credit. Similarly, the average debtors can be calculated by taking the opening and closing trade receivables, which is already given. And hence we'll compute the ratio by dividing these, getting a ratio of 5.33. So an average debtor of 1 rupee would contribute to 5.33 rupees of sales. Understood? Now they have also asked us to compute the debtor collection period. If you read the last line of the given illustration, they have asked us to compute the debtors collection period. We have already discussed this. This can be computed by dividing months or days in a year. Here we'll take days in a year by debtors turnover ratio that we have already computed. So the debtor collection period would come up to 68.48 days. So on an average, it takes roughly 69 days for collection from debtors. Right? Understood till here? Okay, let's move on. The last kind of ratio, the last category that we need to discuss are the profitability ratios. Basically, calculate how much profit the business is earning with respect to a particular aspect of the business. That aspect could be sales, turnover, then capital, or it could be assets, or it could be anything, but the focus still remains on the profit in general. These are very easy and simple. More than ratios, these are in the form of percentages. Basically, multiply the ratio, whatever ratio it is, by 100, and you get that ratio in the form of percentage. The first one we have here is gross profit ratio, which is calculated as the percentage of sales. So gross profit ratio equals gross profit, which we take from the trading account, divided by sales or turnover, revenue from operations, into 100. There is no particular norm in judging these ratios, but higher the better. This you can already figure out. Higher these ratios, better the company is. Because a higher ratio will indicate that there's still profit left from the sales to cover the other indirect expenses. Because gross profit is transferred to the profit and loss account to cover the other indirect expenses. So, higher the ratios, higher the chances of the company is to cover the other indirect expenses. Or it could be any fixed charge or any other expense which comes under the profit and loss account. Similarly, we have net profit ratio, and no points for guessing that net profit ratio equals net profit divided by sales into 100. Basically computing what percentage of sales is the net profit. As simple as that. This most importantly indicates the efficiency with which the business are being done, with which the business are creating profits. Understood? Now suppose the trading and profit and loss account for a particular organization is given, and we are asked to compute the gross profit as well as the net profit ratio. This is very easy. We need gross profit, which is already given, and then divided by sales or turnover to get the gross profit ratio. Here this ratio is coming up to 33.54%. So the gross profit is almost 1/3 of the turnover. Think about it. Okay. Similarly, we'll compute the net profit ratio. Here we'll divide the net profit by turnover. This would come up to 18.75%. Easy, right? I hope there is no doubt here. We'll move on to the next topic. Okay. Now, similar to these ratios, there is another ratio under the profitability category. That is overall profitability ratio, more popularly known as return on investments, ROI, which implies operating profit divided by capital employed into 100. Operating profit means the profit computed just before interest, that is interest on long-term borrowings, as well as just before taxes. This is known as EBIT, earnings before interest and tax. And then capital employed means shareholders' funds and non-current liabilities, that is long-term debts. And how do we interpret this ratio? See, profit is the overall objective of the business, and this ratio is the barometer of the overall performance of the enterprise. It measures how efficiently the capital employed, both shareholders' funds as well as long-term debts, is being used in the business for creating profits, for how much capital, how much profit the business is able to generate. That's it. Understood? Let's take an example on this also. Suppose we are asked to compute ROI from the given information that you can see on your screen. Now, to compute ROI, we need a numerator and a denominator. The numerator being net profit before interest and tax can be computed as net profit before tax is already given, that you can see. So if we add the interest to this, which was already deducted before tax, we'll get the net profit before interest and tax, right? Because when we compute the profit, we first deduct interest and then only we'll deduct tax. Here net profit before tax is given. So tax is not deducted here. That is not our issue. Interest has already been deducted here. So we'll add the interest to get the net profit before interest and tax. Right? As we can see, the net profit before interest and tax would come up to 1,68,000. You are understanding how we have taken the interest, right? We have taken the interest from here only, the information given. Okay. Next, we'll compute the capital employed, which we can calculate by adding all the sources of funds. So we'll add share capital, reserves and surplus, and 12% long-term borrowings. This will come up to rupees 5,50,000. Now, ROI would be equal to 1,68,000 by 5,50,000. That is 30.55%. How is this interpreted? Basically, whatever capital we have employed, the return on such capital is 30.55%. The capital employed is making us earn 30.55% of that particular capital. Understood? Okay. Other than what we discussed so far, there are certain other ratios too, which we need to discuss. First one is EPS, earnings per share. Very easy. Earnings divided by shares. Earnings means profit which is available for equity shareholders after we have paid all the interest, taxes, preference shares, dividends, and all the expenses have been dealt with. Shares means the number of shares held by the owners of the organization. So its basic interpretation is, what is the earning if a person holds one share? Easy to guess, higher the better, because that will mean more earnings per share. Understood? The other ratio is PE ratio, price earning ratio, which means how much times the market price of an equity share is of the earnings per share, which we just now understood. So P ratio equals to market price of a share divided by earnings per share. Think about it. How will this help? Basically, this will help the investors in deciding whether or not to buy a share, whether or not to invest, depending on how many times that investor will have to pay to earn a particular amount. Because here we are computing the market price, the number of times the market price is of the earnings. So basically we are calculating how many times we are capable of being paid for that particular earnings. Right? Okay. Now let's take an example. Suppose we are asked to calculate the P/E ratio for XYZ Limited when the company's stock price was listed at rupees 120. The company's profit for the fiscal year was 48 lakhs and the number of shares outstanding was 1,20,000. Now, to calculate the P ratio, we need the market price per share, which is already given, as well as the EPS, earnings per share, that we have to calculate. How do we calculate it? We take the earnings or the profits for the year and we divide it by number of shares outstanding. So 48 lakhs, which is the profit for the year, divided by 1,20,000, number of shares outstanding. What we get is 40 rupees per share. So a shareholder is earning 40 rupees for each share he holds. Right? Now, P ratio equals to market price per share divided by earnings per share. Simple. Market price per share is already given, 120. EPS we have calculated, 40. So 120 divided by 40 equals to 3. So what the P ratio is? 3. What does it mean? It means to earn a rupee per share. To earn a rupee per share, the shareholder is paying 3 rupees per share. Right? Because we are dividing the market price by earnings. So for each rupee earned or it is earning, the shareholder has paid 3 rupees per share. Understood? Very easy? Okay.